4 years ago, I took 5 separate $100 bills and placed them into 5 completely different investment vehicles. Not because I needed the money, but because every week someone asks me the same question.
Today, I'm opening the vault. We're comparing real numbers, real gains, real losses, and I'll show you which path might be right for you, depending on what you actually want from your money.
Stay with me. By the end, you'll understand something most people never figure out. Let me tell you about a problem I see constantly. People hear success stories. Someone's cousin tripled their money in crypto, or a coworker bought a rental property, and they think, that's the answer. That's what I should do.
But here's the truth. There is no single best investment. What works depends on 5 critical factors, and most beginners ignore at least 3 of them.
We're going to use this framework today, a filter, if you will. Each investment gets measured on these 5 dimensions. Not my opinion, not hype, just facts and outcomes. Learning difficulty, passive earnings, tax treatment, risk exposure, actual returns.
And before we go further, I'm not licensed to give you personal financial advice. I'm simply a researcher sharing what happened when I tested these methods myself. Your situation is yours alone. Understood? Good.
Let me introduce you to the 5 contenders. This is where you buy a piece of one business. Think of it like becoming a micro-owner of Tesla, or Coca-Cola, or Disney. The first pathway is called direct company ownership, and it's exactly that. You own a small slice of a
slice. You get one slice of a massive pie. Now, the catch? You need to actually understand the company. Not just, I like their products. I mean, reading financial reports, understanding cash flow, knowing who's running the show.
The learning curve here is steep. You're essentially becoming a business analyst. But if you pick right, the rewards can be substantial. And here's where it gets interesting. Dividends. Some companies pay you just for holding their stock. It's like rent from a tenant, except you own part of the...
Tax-wise, this can be efficient if you use special accounts. In my country, it's called a Stocks and Shares ISA, basically a protective shell around your investments. Risk? High, very high. Companies fail, industries collapse. I've seen it firsthand.
Imagine pooling money with thousands of strangers to buy shopping malls, apartment complexes, warehouses, then splitting the rent. That's what these are. Legally, they must distribute 90% of profits back to investors. It's built into the structure.
The learning curve is moderate. You don't need to understand plumbing or property law. You just need to understand which types of real estate are performing well. Passive income? Excellent. These investments are designed specifically for generating regular cash flow.
Risk sits in the middle. You're diversified across properties, but if the economy tanks, commercial real estate can suffer. Now we enter controversial territory. Digital currencies operate outside traditional banking systems. No government controls them.
The learning curve is moderate, but it requires understanding completely new concepts. Wallets, exchanges, security protocols. Passive income exists through mechanisms like lending your coins or helping validate transactions. But honestly, I don't touch these methods. Too many.
Tax efficiency? Poor. Almost every transaction triggers a taxable event in most jurisdictions. And risk? Extreme. I'm talking 70% crashes, 500% rallies, complete volatility. If you don't understand that roller coaster, you're not just paying taxes, you're paying with yours.
Gold has been valuable for over 5,000 years. When empires collapse, gold endures. This isn't about getting rich quick. It's about preserving what you already have.
The learning curve is low. Buy physical coins or bars, or invest through funds that hold gold for you. Passive income? Zero. Gold just sits there. It doesn't generate cash. But
tax treatment can be favorable, especially with certain coins that count as legal tender. Risk is medium. Gold won't make you wealthy, but it rarely loses all value.
Final option. Instead of picking individual companies, you buy a basket containing hundreds of the largest businesses. It's called an index fund. You're betting on the entire economy, not single players. Think of it as a market basket approach. Apple, banks, retailers, manufacturers, all in one place.
Learning curve? Minimal. This is the lazy person's investment, and I mean that as a compliment. You set it up once, contribute regularly, and let decades do the work. Relax, stick with the plan, watch your money grow. It's really that simple.
Passive income is moderate through dividend distributions, though growth is the main goal. Tax efficiency is excellent with the right account structures. And risk? Relatively low because you're diversified across hundreds of companies. If 10 fail, you have hundreds still succeeding.
All right, let's get specific. 4 years ago, I documented this entire process. For the single company route, I literally threw a dart at a list of stocks. Completely random selection.
Landed on Samsung. Seemed promising at the time. Today, that $100 is worth $67.72, a loss of 32%.
Here's the lesson. That same dart could have hit different targets. If I'd landed on Nvidia, I'd have nearly tripled my money, but I didn't. That's the lottery aspect of individual stock selection.
Stocks have boomed in recent years, and luckily I have some of those in my personal portfolio. But this just goes to show you can't just leave individual stock investing down to luck. You have to be strategic with your stock picks, and even then the market is unpredictable. If you want to try this out, just download Trading 212.
Real estate collective fund, I chose one focused on commercial properties. After 4 years, my $100 became $98.59, a small loss of 1.4%. But remember those mandatory distributions? I received $11.93 in
result, $110.52, a gain of 10.5%. Not spectacular, but remember, commercial real estate struggled during the pandemic. Property sat empty. This actually demonstrates the resilience of the structure. But it's very...
Now for the controversial one. I put $100 into the most established digital currency, Bitcoin. 4 years later, that investment is worth $652.12.
552% return. Extraordinary, yes. Typical? Absolutely not. This is the best performing asset of the past decade, but most digital currencies have gone to zero.
For every success story, there are hundreds of complete losses. This is speculation, not traditional investing. Gold, the ancient storage of value. My $100 is now worth $140.11, a 40% gain.
It's as exciting as the digital currency explosion, but gold did exactly what it's supposed to do. Preserve and slightly grow wealth during uncertain economic times. Inflation protection in action.
The approach I personally favor most, the broad market basket. I invested in an index tracking the largest 500 companies in America. Today, that $100 is worth $179.57, a 79.6% return.
This is why I allocate the majority of my wealth here. Consistent, reliable, diversified. But notice, I still use all 5 methods. Different tools for different purposes.
Let me summarize this visually, because your brain will remember pictures better than numbers. If we plot these on a risk-reward grid, low risk sits down here, higher potential return up here. The shape tells the story at a glance. So,
individual stocks land here. High risk, high potential reward, but also high potential loss. Digital currency sits in the extreme corner. Highest risk, highest possible return, but also highest disaster probability. Generationally,
Gold sits in the lower left. Low risk, modest returns, stability focused. Real estate funds fall in the middle zone. Moderate risk, moderate returns, steady income. And market baskets sit in the sweet spot for most people. Medium risk, strong long-term returns, broad diversification. Over
cloud to not just worry you about. Now watch what happens to $1,000 in each investment after taxes. Digital currency gets hit hardest. Every transaction triggers taxes.
Individual stocks in market baskets and protected accounts avoid most taxes. Understanding tax treatment is worth thousands of dollars over a lifetime. If yours not interested yet, $50,000 plus cash tax against saved and $19,000.
Something crucial people miss. Your time frame changes everything. If you need money in 1 year, gold might be safest. If you have 5 to 10 years, real estate funds or market baskets make sense.
If you have 20 to 30 years, market baskets historically dominate. Time is the secret ingredient that transforms small amounts into substantial wealth.
So what should you actually do? Let me give you a framework.
If you're starting from zero, follow this sequence. Open an account that protects you from taxes. In my country, it's called a Stocks and Shares ISA. In America, you might use a Roth IRA. Find your country's equivalent.
Work with market baskets. Get 80% of your money into broad index funds immediately. Add 15% into real estate funds for income diversification. Put the final 5% into gold as disaster insurance. That's it. That's the boring, proven wealth-building formula.
Been investing for a few years and want more control? Keep 60% in market baskets as your foundation. Add 20% into carefully researched individual companies. No more than 5 stocks. Study them deeply. Yeah, just for
take 10% to real estate funds for cash flow. Put 5% into gold for protection. Consider 5% in established digital currencies if you can stomach the volatility. Only Bitcoin and Ethereum, nothing exotic. This adds complexity but keeps you protected.
You're young, have stable income, and want aggressive growth, you might do 50% market baskets, 25% individual stocks, 15% digital currencies, 10% gold.
Understand, this requires active monitoring, strong nerves, and willingness to lose 30 to 40% of your portfolio temporarily during crashes. Most people can't handle that psychologically. They panic and sell at the bottom.
Know yourself. Choose the strategy you can actually stick with through volatility. Let me leave you with the most important insight from this 4-year experiment. Every single investment method I tested had value. Each one served a different purpose.
Single company stock taught me about concentration risk. The real estate fund provided steady income. Digital currency showed me the power of emerging technology and its dangers. Gold protected during uncertainty, and market baskets delivered reliable, compound growth.
The real question isn't which is best. The real question is which combination matches my goals, timeline, and risk tolerance. Start small. Even $100 invested consistently compounds into something meaningful over decades.
Time is your greatest advantage. The sooner you begin, the more powerful compound growth becomes. Don't wait for the perfect moment. Don't wait until you have thousands saved. Start with whatever you have right now. 4 years ago, I invested $500 bills. Today, they've grown to over $1,300 collectively. That's the power of diversification and patience. Thank you for staying with me through this analysis. I hope you found it valuable.
Until next time, invest wisely, stay curious, and remember, the best investment is the one you actually make.